Hello, Namaskar. Myself Deepak Gupta, logging again on this platform of College Dekho, and we will continue our journey of calculation of national income, one of the major topics of macroeconomics. And in continuation of our earlier two sessions, in this session, part 3 of national income, today we will stress on the difference between final goods and intermediate goods. In a nutshell, we have discussed it in the earlier session, but we will again stress on the point today. We will differentiate the difference between factor incomes and transfer incomes. Again, the similar platform that we have discussed in a nutshell in the last sessions, but we will discuss in detail in today's session. And why they are too important? Because only this factor income and final goods. So only the value of the final goods, and that too as per the factor payments or the factor incomes, will be considered for the calculation of national income. And these intermediate goods and the transfer incomes, they will not constitute the calculation of the GDP or the national income, because the value of the intermediate goods have already been included in the value of the final goods. And transfer incomes, they may be a part of private income, personal income, disposable income, but they will never be a part of the factor incomes via national income calculation, because they are not paid because of certain productive activities. The national income and the GDP, they primarily denotes the value of the goods or the services that have been generated, and therefore transfer incomes which are paid without any work being done, therefore they will not constitute a part of them. And in the third stress we will discuss, and which we have already discussed in nutshell, the net foreign income from abroad, because that is the basic difference between a national income and a domestic income. And we have told it in the last session that ideally national income will be equal to domestic income plus NFIA. So what is NFIA? We will again stress on this. And fourthly, obviously not the least, that when we talk of final goods, these final goods can be of two kinds. One can be capital goods and another can be consumer goods. As such, the classification may not be important for the calculation of national income, but the capital goods, they have a wear and tear because of time and the usage, which is normally known as depreciation. So we can always have the value of the assets either without depreciation or after depreciation. That is why we can have the value as gross as well as net. And the last topic for the day that we will try to cover will be that out of this gross and net values of the capital goods, there is one more thing, that whenever you purchase these goods, whether they are capital goods or consumer goods, there are certain indirect taxes which are like GST, which are being paid by the public to the government. And in some cases, the government provides you subsidies. So subsidies are what you are receiving from the government as a consumer, and indirect taxes are what you are paying to the government as a consumer, and the net of the two will be known as net indirect tax, that is NIT. So we can have the value of the goods or the services of the final goods either without these net indirect taxes figures or with net indirect tax figures, and therefore we will have this concept of market price and factor cost. So factor cost is actually the value of these factor incomes, and therefore this market price is equal to factor cost plus net indirect tax. So basically speaking, that these figures of NFIA, depreciation and net indirect tax are the key to understand the various aggregates of the national income. So in the next session we will discuss the aggregates, various aggregates of national income, and once we are done with the aggregates, then we will as a last step resort to the methods of the calculation of the national income. So the last part of that session series will be the methods of national income calculation, and there are different methods, and that we'll be discussing in the sessions to come. So what we are stressing here is that these will be discussed more or less in the coming sessions on national income, and we will try to cover all the above till this line above in this session. So, first and foremost, the topic that we started with is the final goods and the intermediate goods. Now, why this classification is important is because that we started with that there is always by character a two sector economy, which includes the household, which is basically the consumer, and the firm, which is basically the producer. So in the case of real flow, because household gives you the factors of production and receives in return the goods and the services. Or if we talk of the money flow, that firm gives factor payments oblique factor incomes to the household for the factors of production, which in turn is paid back to the firm by the household in the form of consumption expenditure. So what is happening here, that the payment is made by the household for the goods or the services which have been received by the firm. So there can be a case that between this household and firm there is also another firm which buys goods from one firm and sells to the household. Now these are in a way like this firm. So if there is a transfer between firm to firm which is to be carried forward to the household or the consumer, then this transfer of goods shall be the intermediate goods. And when they reaches the consumer or the household, only then they will become the finished goods. So any kind of good, if traded, if given to firm by a firm, shall constitute an intermediate good. But any other good which either from the original firm or through intermediary firm reaches the consumer, that is the household, only then it becomes a finished goods. One of the most common example is of sugar. So it can happen that Mr. X, a consumer, goes to a kirana shop and buys sugar. Another can be Mr. Y goes to the kirana shop and buys sugar. In both the cases, the seller is the firm kirana shop. In both the cases, the goods to be discussed are similar, that is the sugar, but the person is here X and here Y. And what is the difference between the two? That X is buying the sugar to make tea for himself, and here the Y is a sweet shop owner who is buying for making sweets for resale. So this Y is acting as another firm because he will buy the sugar, use it in the sweets, and then sell it to the consumer. So in a way, the value of the sugar will be added in the value of the sweets, and hence this sweets when sold to the consumer, then they will become the final good. So in this case, this sugar is sold by the firm to the firm. This sugar is sold by the firm to the firm, hence it is intermediate goods, because another way of explaining is that it is an intermediate good because it is remaining inside the production boundary, because it will be again used by the sweet shop owner to produce certain goods. So whenever there is a good inside the production boundary, then we use the word intermediate good. And in this example, sugar is an intermediate good, but sweets, in this case sweets, and in this case the sugar. तो ये sugar पहले वाले केस में और sweets दूसरे वाले केस में, they are exiting the production boundary. They are exiting the production boundary and reach to consumer. So whenever a good exits the production boundary, only then they will be known as final goods. So the similar item sugar in one case can be intermediate good, in another case can be a final good. So it is not about the nature of the goods that decide whether it is a consumer goods or whether it is a intermediate good or final good, but the destination that decides whether it is a final good or not. So all those goods which reaches the destination, that is the consumer, will be deemed as the final goods, and the value of such final goods will be the value of the domestic income or the national income, as the case may be. But the value of the intermediate goods will be included in the value of the final goods. So we are not saying that the intermediate goods are not a part of national income, but we are saying that the value of the intermediate goods is already added in the value of the final goods for which it has been used, and therefore their value is not to be added separately for the calculation of the GDP or the national income, because if we do so, then there will be double calculation. Okay, now I hope this is clear. Now if we move further, then we said that factor payments and transfer payments, that we have already discussed, but just anything that could have been left there. The factor payments are primarily the rent which has been given on the land. It is the wages, that is the salary which has been paid on the labor. It is the interest which has been paid on the capital, and it is the profit which has been paid on the enterprise. So this LLCE, they constitutes the factors of production, as already discussed in the first session on national income. And this rent, wages, interest and profit, that is RWIP, they constitute factor payments from the point of view of the firm, or the factor incomes from the point of view of the household, but they are one and the same thing. And therefore any other payment which has been transacted between two parties is not to be taken as factor payment. And for example, when we pay taxes to the government, or when the government gives us subsidies, so subsidies by government, okay? Similarly, there is any scholarship by the government to the needy students, or there is any kind of unemployment allowance by the government to the unemployed, then such payments are made not for the work that has been done, but in addition to in addition to such factors of production, this payment has been made without being any effort being done to generate them, and therefore they are transfer payments. And such transfer payments are not included, they are not included in domestic income or the national income, whereas these factor payments or factor incomes, they are included in domestic income, gross domestic product or the national income. Okay? So now moving further, I hope that we are done with this final good. We are done this with factor income. This NFIA, we have already discussed that this net factor income from abroad is the excess of the factor incomes which have been brought to India or which have been brought into India by residents वर्किंग आउटसाइड, जो इंडियन रेजिडेंट्स इंडिया से बाहर काम कर रहे हैं और वो वहाँ से जितना पैसा इंडिया में लेकर आते हैं, इसको हम शॉर्ट में क्या बोलते हैं, फीफा, फॉरेन इनकम फ्रॉम अब्रॉड. And I said excess of this over, so it means this minus the factor incomes that have been taken out of India. यानी कि इंडिया से बाहर लेके चले गए, फॉरेन इनकम टेकन आउट ऑफ इंडिया बाय नॉन रेजिडेंट्स वर्किंग इन इंडिया. तो जो नॉन रेजिडेंट्स इंडिया में काम कर रहे हैं और वो इंडिया से जो बाहर लेके चले गए, इसे शॉर्ट में क्या बोलते हैं, फॉरेन इनकम टू अब्रॉड, that is the FITA. So we always say that this net foreign income from abroad will be equal to FIFA minus FITA, and therefore when we calculate the national income, because national income focuses the value of the goods and services by non-residents, so the national income focuses on the residents' income, whereas the domestic income focuses on the income or the value of the goods of the domestic territory, irrespective whether it has been generated by the residents or the non-residents. Therefore, this domestic income has to be deducted by FITA, because this is the foreign income which has been taken out of India. So this will reduce the domestic income to calculate the national income, and vice versa is the case with the FIFA, and therefore domestic income plus NFIA, that constitutes the national income, and it itself denotes that कि आपने national income में FIFA ऐड कर दिया, यानी कि डोमेस्टिक इनकम में जो रेजिडेंट्स इंडिया से बाहर कमा के लाए वो ऐड कर दी, जिससे कि हम रेजिडेंट की इनकम निकाल सकें, और जो इनकम नॉन रेजिडेंट्स ने कमाई है उसको माइनस कर दें, बिकॉज हमारा स्ट्रेस सिर्फ नेशनल इनकम पे, रेजिडेंट्स की इनकम पे. इसलिए इफेक्टिवली ये हो क्या गया कि आपने डोमेस्टिक इनकम में रेजिडेंट्स की इनकम जो बाहर से आई उसे प्लस कर दिया, और नॉन रेजिडेंट्स की इनकम जो हमने ऐड कर रखी थी वो माइनस कर दी, एंड दैट इज़ वाई इसको हमने NFIA करके शो कर दिया. सो आई होप NFI is now clear to you. Now the other aspect is that these final goods, are classified as the capital goods. Basically, the capital goods denotes the investment. That is the capital stock which has been, or I should say the net stock which has been added to the value of the GDP or the value of the goods and services which have been created, and they will give benefits over a longer period of time. And these consumer goods, they are not constructed or produced, or they will not give benefits over a longer period of time. That is, the consumer has not purchased the consumer goods as investment, but they are being purchased only for consumption purposes. So therefore they can either be durable. तो अगर आपने अपने घर में AC चलाया तो अकाउंट्स की लैंग्वेज से वो असेट है, लेकिन इकोनॉमिक के एंगल से वो ड्यूरेबल कंज्यूमर गुड है, बिकॉज यू आर यूजिंग इट just to satisfy your needs. The consumer goods are the goods which satisfy the needs, the wants of the consumers, and the capital goods are those which satisfy the investment objective of the consumer. तो अगर एक बिजनेस ने अपने प्रोडक्शन के लिए मशीनरी खरीदी तो वो सेल्फ यूज़ के लिए है, वो एज ए कंज्यूमर है, बट उसका बेनिफिट मल्टीपल ईयर्स के लिए होगा और ऑब्जेक्टिव भी इन्वेस्टमेंट है. दैट इज़ वाई इट बिकम्स अ कैपिटल गुड्स. बट वही अगर एक कार आपने पर्सनल यूज़ के लिए ली तो ड्यूरेबल है, मल्टीपल ईयर यूज़ होगी, बट इट इज़ ओनली टू सेटिस्फाई द वांट्स एंड इट इज़ नॉट एन इन्वेस्टमेंट पर्पजेज. दैट इज़ वाई इट बिकम्स अ कंज्यूमर गुड्स. तो आई कैन ऑलवेज से कि आपने घर खरीदा रहने के लिए तो एक इन्वेस्टमेंट ऑब्जेक्टिव है, लेकिन अगर आपने गाड़ी खरीदी अपने खुद के चलाने के लिए तो एक तरीका कंज्यूमर गुड है. बट In both the cases, that is not much important for our discussion, because they both are final goods, and the final goods will be included, that is their value, whether they are the goods or whether they are the services, their value will be included in national income or domestic income. But the point to be noted is, or I should say the point to be remembered is, that these capital goods or this gross investment, so instead of the word gross, I will just write the word investment, that this investment will be decreased by wear and tear and usage और टाइम यूज करने से, रख रखे खराब होने से, या विद द कंजम्पशन ऑफ टाइम, दिस इन्वेस्टमेंट may decrease, and the measure of this decrease is what you call depreciation. So basically depreciation is the measure of the decrease in the value of an capital asset or the investment, either through wear and tear or usage or time. Also basically it denotes a kind of normal obsolescence. जो नॉर्मली चीज की वैल्यू खराब होगी, जो पुरानी होगी, वो नॉर्मल ऑब्सोलेसेंस को क्या बोला गया? डेप्रिसिएशन. And therefore, if we charge the value of the investment originally, that is without depreciation, or we can charge the value at present, that is the present value after the obsolescence. So this present value is after obsolescence, that is after depreciation, and we use the word net value, and this value is before depreciation, and hence we use the word gross. So we can always say that the value of the gross investment will be equal to net investment plus depreciation. So why this is important, that you will notice that sometimes I am writing DI, that is domestic income, and sometimes I am writing GDP. So that you all know that we can also use the word domestic income or domestic product. That is one and the same thing. But in this domestic income, there is a value of the final good that has been included. And those final goods can either be capital goods or the consumption goods. So the question will arise that whether you are charging those capital final goods at without depreciation value, that is the gross value, or after depreciation value, that is the net value. So we can say that if it is a gross value, then we use the word GDP, gross domestic product, or if you're talking about the national income, then we can say gross national product or gross national income. And we talk about the word net, then we can say net domestic product, or we can say net national product. So normally what domestic income and national income is, that whether it's a gross value or net value, that what will be discussed in the next session when we will discuss the aggregates of the national income. So continuing this journey, the last point that comes into mind, that is, and they are also known as the basic fundas of the national income, is that what is the market price and what is the factor cost. So for this I am discussing through an example that there is a company X Limited, known as the firm, which sells the goods to Rakesh, which is a kind of household, the consumer, and the value is 10,000 rupees. Now, depending upon the nature of goods, there will be taxes which will be levied by the government, which will be charged by this firm on Rakesh. So let's presume that this is subjected to 18% GST, and also this good which has been sold for rupees 10,000 is some good which is good for the environment or which reduces the pollution depending upon the various criterias as selected by the government. Government provides benefits to the consumer if they opt to buy certain goods. फॉर एग्जाम्पल अगर आपने एक टू व्हीलर खरीदना है और अगर आप एक कन्वेंशनल पेट्रोल टू व्हीकल खरीद रहे हैं देन यू आर doing nothing for the environment and you are behaving normally. But if there is another person who is taking a risk and he is buying an electric scooty, then he is in a way helping to reduce the pollution and save the environment. And because these electric scooters, because they are new in the market, they are expensive in as compared to the performance ratio to the other conventional mode of two wheelers. Therefore, to support such buying exercise of consumer towards electric scooties, electric two wheelers, the government is providing subsidies. So similarly, on as I discussed the scooties, electric scooties, it can be solar panels, it can be certain other kind of items. The list can be known from the other sources, not to be covered in this session. That government is ready to provide certain kind of subsidies, but at the moment, the most two hit and appropriate and most commonly used items at the moment are the solar panels and the electric vehicles. So keeping that thing in mind, if I say that 1000 is the subsidy which has been given by the government on such goods. So what is happening here that on a price of 10,000 which included the cost price plus the profit, and this cost price will either be rent or the wages or the interest. So basically this 10,000 is RWIP, that is the factor payment, or we should say the factor cost. On this at the rate 18%, 1800 is the indirect tax and subsidy of 1000 is to be deducted. So the price to be paid by the consumer is 10,800, which basically denotes the market price. And how this market price has been calculated, that in the factor cost you have added the indirect taxes 1800 and you have deducted 1000, that is the subsidy. So these two items, they are known as net indirect tax. So if the net indirect tax is positive, it means taxes are more than the subsidy. But in certain cases, the subsidies are so huge that they exceed the indirect taxes, or it may happen that on certain goods there is no indirect tax, that is, they are exempted goods, and in addition to that, the government is also providing subsidies. In that case, the net indirect tax could be negative. So therefore, factor cost plus net indirect tax, that becomes the market price. So we can always say that market price will be more than factor cost if NIT is positive, that is, indirect taxes are more than subsidy. Similarly, market price can be equal to factor cost if NIT is 0, that is, either indirect tax and subsidy are 0 or they both are equal, and the market price can be less than factor cost if NIT is negative. It means indirect taxes are less than subsidy, which can happen that either the subsidy is more obviously, or there is only subsidy on certain goods and no indirect taxes are to be charged. So here we close this session, and these three sessions, they actually constitute the basics of the macroeconomics that should be understood to clearly calculate various aggregates and the value of the national income, which we will be starting from our next session onwards on national income. So from national income 4 session onwards, we will be discussing the what are the various aggregates of the national income. And on this note, myself Deepak Gupta signing off.